Hey everybody, welcome to the Boring Investor Breakdown, the show where hype fades, risk cools off, and real wealth takes center stage. I'm your host, StockMarket Jay. In every episode, we cut through the noise to reveal the slow, steady, proven strategies that actually build long-term financial freedom. So that means no crypto drama, no get-rich-quick schemes, just practical investing, quiet growth, and money that works as hard as you do. Okay, let's break it down the boring way, right? So this is a new segment that I'm building out. If you haven't been keeping up with me, of course, I'm Stock Market Jay. I'm here to say today, still bringing you the news you can use, right? So fundamental breakdowns, market analysis, and of course, different things that are happening in the markets. Everyone that does know me, that has listened to me, you know that I take a long-term practical approach, right, to investing. I'm a value investor. I've been investing since 2021. I've created a book, Stock Beginner's Guide to Stock Market Investing on Amazon. I've got independent books that I've wrote and sold outside of Amazon, created courses, things like that, right? And of course, just to add some context, my investing idols, mentors, or people who I've built my investing philosophy on, the likes of Warren Buffett, Charlie Munger, Peter Lynch, Jamie Dimon, right? So just kind of give you an overview of, kind of how I operate. I'll get into the new segment, the boring investor breakdown, right? And just to kind of add some context to it. So, of course, Warren Buffett, Charlie Munger, both widely known as long-term investors. They don't buy and sell. They don't trade, day trade, or options trade, things like that. It's practical. It's a long-term approach. Reinvesting those dividends, consistent investments, rational approaches, not getting caught up in market hype, understanding businesses fundamentally, right? And then of course, investing in businesses that are undervalued in the eyes of the market, and in terms of the stock price, with the high upside, and then of course, capital protection, so risk management, things like that. And then, of course, being rational longer than the average person and investing, or financial literacy, which is what this is about. The boring investor breakdown is going to be me giving you philosophies and values from tried, true, proven investing strategies, styles, and people that continue to work today. And while it's not flashy, while it's not gonna get you rich quick, it will build you consistent, steady wealth over time, right? And it's a practical approach to investing, but this is going to be more geared towards me looking to help people in terms of financial literacy, financial education before the investing segment, right? Don't get me wrong, I love stocks. I love the financial markets as a whole, and as I've gained a broader perspective of the markets, I've been able to kind of deduce certain things in terms of whether it's inflationary, credit risk, debt markets, things like that, and able to kind of create a more informed decision around my investment thesis and just how I handle my finances as a whole, right? So I currently invest in stocks. I own 8 companies. I'll give breakdowns of that throughout the series. That's it. That's all. I own physical silver, so I'm in the precious metal space, and of course, high yield savings account. Nothing flashy, nothing, and of course, I buy and sell things on the side just to have that active income, but nothing flashy, nothing too crazy, or nothing that's gonna explode your earning ability or financial independence journey faster. But also, I'm not doing anything that's gonna hinder me along the way, right? Which is what the boring investor breakdown in series is going to be about. Long-term approach. That's going to be number one. We're taking a long-term approach to investing and building wealth, right? And that's, like I said, just through understanding capital markets as a whole, stock market, right? That's where my area of expertise is. I've diverged into precious metals. So, of course, I'm going through things in that nature. And, of course, I believe in just things that remaining liquid. You want to be liquid, especially in times like today where markets are really overvalued from a standpoint of it's only a few companies that's holding up and pushing up the markets. The rest of the markets are pretty much on a downswing. So you want to protect yourself, and you also want to be ready for what's to come. So making sure that you're liquid enough to take advantage of those downswings, because when stuff hits the fan, when things go down in value, as they always do, because like I said, markets are irrational, so that means that things will be trading at premiums, high valuations based on an earnings basis, right? On a price to earning basis, price to sales basis, price to book race basis. They'll be selling overvalued at a high, where you have some areas that are undervalued in those same areas, even when it comes to all of their assets, capital allocations, and different things of that nature, versus where their stock price is trading. So some companies have inventories, real estate, products, things like that, cash that amount to, when you divide it by the outstanding shares they have, it amount to more than what the stock's price is trading at. So their business as a whole is worth more than what the stock is trading at. So a long-term approach, just basically what that means is, man, the S&P 500 has yielded between 7 to 10% per annum, per year, annualized over the long term. Forget what it's done this year, forget what it's done last year, forget what it done in 2022, 2020, forget what it done in 2008, forget what it done throughout history, 1929, forget what it's done throughout history. Over time, 7 to 10% of your money is a good return. That's just trusting the market. That's just trusting the American economy, right? Being a capitalist, investing. You don't have to yourself be a capitalist. You live in a capitalistic society, so you might want to take advantage. And in terms of doing so, you're able to take advantage of investing in America. America always bounces back. They always have. Every time it's been a downturn, there's been an uptick, right? You get booms, you get busts, you get progressions, you get recessions. It's just how capital markets work. So a long-term approach yields you about 7 to 10%. You can do better than that, trust me. But of course, with the long-term approach, you want to be ready. You want to be fluid, right? You want to have liquid capital on the side working for you in the debt market, such as a high yield savings, a CD, T-bills, whatever you want to do, treasury notes, whatever it happens, whatever instrument you want to use. High yield savings accounts tend to be more liquid. You can pull the money out, transfer it, move it a lot quicker than T-bills or 30-day T-bills, 60-day T-bills, 2-year CDs, things like that. So for me, remaining as liquid as I can, so I can take advantage of those opportunities that come in the market at the drop of a hat, that is a major key player for me in terms of my investing strategy, as well as I do have investments that I have locked up, money that I don't need, right? I have it's a REIT that I invest in called Concrete. I get about a 6.5% return on my money. I've been investing to them for a couple of years, but it takes a while if you need that money. If you're getting a pinch, you're getting a bind, it takes about a month to get that, for them to exit. It's real estate backed. It's a real estate investment trust. It's a REIT. So it takes a while for them to sell that position, close it to you. They will get you your money. It just takes a while. So I look at that as like maybe a high yielding T-bill, T-note, or a bond, right? It's short term, so you can have your money back in a month. You can accrue interest over that time if you happen to, if you steadily add into it, pays your dividends every week. Beautiful tool if you don't need the money. Precious metals can easily be sold. Silver can easily be sold. You can go to any local coin shop, sell it online, eBay, auction, or whatever you want to do. Of course, with precious metals, you want to make sure that you're doing your due diligence. People sell fakes all the time. Don't get conned out of your money. You spend your hard-earned money on this. It's supposed to be a storehouse of wealth. You don't want to essentially flush it down the drain. Go to a reputable source, your local coin shop, or of course a online dealer. I prefer the local coin shop route only because you get to build that rapport with them. They give you deals and stuff like that, and they can get you closer to spot price, which is actual what the ounce of that coin is actually selling at, or whatever metal is actually selling that currently. So a lot of places they'll charge $3, $4, $5, and you gotta pay shipping if you're doing it online. Whereas your local coin dealer just say, give me $1 or $2 over spot. My local coin guy has given my kids grams of silver just because we have a relationship. And even on my son's birthday, gave him a sterling silver necklace and pendant with it, which is awesome because if you know anything about precious metals and silver, sterling silver is 925 silver, 925 fine. So it's 92% fine silver, right? Can easily be sold. You can use it for some strange reason. People that I've come across that have built massive amounts of wealth, they're like, I don't know if I wouldn't call them conspiracy theorists, but they're definitely like fidgety, like kind of fickle they're nervous, man. They're like doomsday prepping. Like, if stuff ever hits the fan, I can go to Mexico and just take my gold, or like, stuff like that, or like, if we get into a civil war or the economy crashes, and I always got this right here. I don't get it from that standpoint. I do look at it as a storehouse of value. I started buying silver at about $28 an ounce. It's now $51 an ounce. I still buy it as a dollar cost average into it. Again, long-term approach. I'm not waiting on it to come back down. Storehouse of value, right? Just like stocks come down in price, I add more. And when they go up, I still happen to buy if it's at fair value. And that's what I'm doing with silver. It's just a storehouse of wealth. I don't need it. It's fun to collect. And it's a great way to have a savings that's easily accessible, not as accessible as the high yield savings, but just as easy. That's what the long-term approach is, right? We're playing the long game. I'm not trying to get rich tomorrow. I'm not trying to get rich next year. I want to have more tomorrow than I had today, and more, next year, a lot more next year than I have today as well. It doesn't have to be $1 million. No, I look at this journey from a standpoint of, man, when I look at my portfolio, because I add new capital to it. So it might have went down because the markets are down, but I add new capital to it continuously. So it's continuing to rise. Or when I'm adding more money to my high yield savings, or when I'm adding more, buying more silver, and things like that. You just watch it over time increase. You look at it, you're like, man, I don't really got a lot here. But when you look at it like 3 months ago, man, I got considerably more than then. And that's what the long-term game is. And of course, the basis of the long-term engine is compounding. Okay, and when you're investing in capital markets, anything where you can yield an interest in, compounding interest is the best. That's the mover, the driver. That's the expediter, which is going to get you to where you want to go. Compounding interest is just the principal or the amount raised by the power of time. That's all compound interest is, right? Time is the biggest driver. The longer you're in the markets, the longer you're invested. You don't want to time the markets. You want to spend time in the markets, right? Some people come in and out, move in and out of positions. Compounding interest doesn't have the ability to take effect. If I'm up 20%, I think markets are about to come down, let me sell. Compound interest doesn't have the ability to work in your favor if you do it like that, because again, it's raised to time, like by time, right? It's whatever that amount is, compounding in a rate by the time. The longer you're in that position, the longer that you have compounding on your side, the larger those gains will be. That's why if you're, let's say, 18, you can invest $200 to $250 in the S&P 500 every single month for 40 years, and between 30 and 40 years, you'll be a millionaire. Whereas if you're 30 and you did that, you'd have to invest twice as much, or you definitely wouldn't have the same amount of return in that time span as the person that started at that earlier point, only because they've had more time to compound. You can do double that amount and you still won't have the returns that they have, simply because they have time on their side. So when investing or building wealth, anything long-term, building a business as well, time is going to be your greatest asset. Okay, the amount of time that you're putting into it, whether you're building influencing company, whether you're doing e-commerce, whether you're doing cleaning service, no matter what it is, whether you're doing, whether you got a franchise or you're starting something, you want a franchise, you got to start somewhere. So time is your biggest multiplier, and in the financial markets, it is a great ally. Being diversified. The boring investor breakdown is centered somewhat around minimal diversification. I'm not chasing trends or gains. I know what works. I know what works for me, and that's how I operate. Now, here's the thing. That's it. So precious metals, stocks, high yield savings, REIT. That's my 4 streams of diversification right there. That's it. And I buy and sell stuff on the side. It's 4 streams of income. I'm diversified. Of course, I have a job. I'm diversified. I don't have to. Don't get me wrong. I'm an active investor. So of course, I'm listening to earnings calls every quarter. I only own 8 stocks. Right, so that makes it easy, and of course I listen to other companies' earnings that I take interest in, or I want to see where the economy is going. Because let's say someone like a McDonald's or a Home Depot or a Walmart, they can give you a look into the consumer and into the economy on a micro and macro level, to where you can kind of make an informed, you can come up with the hypotheses, or maybe even an opinion on, or just a course on where you should take your money, whether it's course correcting, whether it's doubling down in a certain area, whether it's understanding, okay, everyone is going through this, don't panic, right? So I'm not, trying to sit here and be involved in every single investment instrument and vehicle. I'm not trying to get into everything that's the latest fad. My diversification is minimal. Like I said, I own 8 stocks. I'll get into those on other series, but it allows me to give attention to each one on a fundamental spectrum where I'm able to break down each stock and kind of keep up with them, with each company's story, because you got a reason why you bought. And then of course, that reason is you want to follow that story, because if that reason changes in a negative manner, it might be time to sell. So of course, I'm able to keep up with the markets I'm in. I'm able to keep up with the companies that I'm on, and I'm able to just kind of put my investments on autopilot. I still actively like, if you're not this type of person, then you just buy the S&P 500 and you just, every check, you get some money allocated towards that, right? I'm the type of person where I like to go in and see what company is doing what. Okay, let me double down here because the stock has went down considerably. Okay, this one's flat. I'll go ahead and add more. Okay, this one's went up a tick. I'll still add into it because I want to still add to my overall position, especially if it pays dividends. But just overall, I get to manage it how I want to. I'm an active investor. I am a passive investor because I don't have to invest. I don't have to watch my investments every day. I'm not watching grass grow or paint dry with my investments, right? I can set it and forget it. I just come back to it every time I get paid. Let's go buy some silver. Let's put some money in my savings. Let's put some money in my portfolio. If I want to, if I got a little bit of capital that I don't need, let's put it in there, lock it up for 30 days or however long if I need to, whatever the case may be, right? It's not really, you take the guesswork out of it, but it is fundamental work that has to go into it as well. So if you're trying to get rich quick, this podcast might not be for you because you have to do work. You have to consistently stay up on what you're doing. Investing might not be for you if you're looking to get rich quick as well, because you have to put in the work. Even if you're doing an investment strategy, whether you're day trading or options trading, or you're doing speculative investing in the crypto or whatever tech company is supposed to go to the moon, you want to at least do your research to stay ahead of the trends and stay ahead of what's to come, because if things hit the fan, you want to at least know, hey, let me pull out. Hey, things are starting to get a little shaky, let me pull out. You gotta think about it. People are starting to sell off on Nvidia right now. And with that, some people are citing the AI tech bubble. Some people are saying that, man, are these companies overvalued in terms of earnings and things like that? Let me shave some of my positions. Some people are selling full positions. Some people are just shaving it down, collecting that capital, because of course markets are going down, and things don't go up forever, right? So you still want to take a proactive approach to your high risk, high reward style, so you can just kind of stay in the know, and you can help yourself out to make sure that you're not riding any trains that are going off the tracks, right? Another key component to the boring investor breakdown is going to be FOMO. FOMO. I don't care about missing out on any trends. I'm not, just because something is hyped up, just because something is supposed to go to the moon, just because everyone is doing it, doesn't mean that I have to do it. I don't care what everyone else is doing. I know what I'm doing. I know what works for me. I stick to what Warren Buffett considers a circle of competency. I do what works for me. I do what I understand, and I do it very well. I take pride in it. I study it. I'm a student of it. I've studied the history of the markets, financial markets and things like that, economic cycles and things like that, to where I'm competent enough to where I have understood that you can't lose money on a trade that you don't make, on an investment that you don't take, on something that you don't do. You can't. There are opportunity costs. That's okay. I missed out on Uber. I missed out on Delta Airlines. I missed out on a few opportunities that I wish I could have back, but guess what? I didn't lose a penny on it. So it's okay. And I learned from different things, and it's a journey, and you get better, and you learn which way to go. The areas that I did lose money in is when I was IPO companies. I was gambling on, not a gamble, but it's like, when it comes to IPOs, you put some money in, it runs up real quick, you take it out and go, right? I got lucky on that a few times. I lost money on that, right? And I've tried day trading, options trading, things like that. Those are the times I've lost money. Did I have a few wins in there? Yeah, sure. I got lucky, I think. But I took a lot more losses in that regards. As far as the things that I do now, my core investment strategies, my core investment thesis, my core investment principles, I haven't taken any losses with it. It's been gains slow and steadily over time, and it's worked, and it still works. Another component to the boring investor breakdown is going to be understanding markets, understanding capital markets, understanding debt markets, understanding global markets, understanding geopolitical factors that impact the markets, understanding, different things that build up, like the microeconomics, the macroeconomics, supply chain, different areas, because this impacts us on a day-to-day basis. Why do you think that you don't get free delivery on certain things on Amazon no more? You got to spend a certain amount to get free delivery on certain things, or prices of goods and services are going up and things like that. Like this, it's a structure. The economy is structured a certain way. You got the people that are building, that are manufacturing the materials at the beginning of the supply chain. These are the guys that are just the raw materials that we get, like the wood, the lumber, the things that they can use to then build tablets, MacBooks, phones, like the materials guys. Those guys, then you got to get it to places. It has to go to different companies. It has to go to different destinations in the world, whether it's going to be by boat, whether it's by train, whether it's by freight, whether it's by plane. It has to be able to get from place to place. These are called supply chains. And then it gets to the producers who build those goods into distributable products, in which the consumer, me, you, everyone else, then purchases and uses for our everyday necessities and wants as well. And then, of course, be boring long enough for compounding to work. So Charlie Munger was quoted as saying him and Warren Buffett weren't smarter than anyone else. They were just rational longer than everyone else, right? And if you can spend less than you earn, and reinvest your earnings and avoid catastrophe, wealth will essentially creep up on you, okay? If you can be rational longer than the average person, right? You're not chasing these trends. You're not trying to get rich quick. You just, like I said, spend less than you make. So don't, because if you want to use those extra funds to invest and do different things. Reinvest those earnings. So of course, take whatever you earn, put it right back into whatever you're doing. That's a growth engine that helps propel you upward in terms of, the growth that you're able to get. And then of course, avoid catastrophe. Don't blow yourself up. Don't do anything crazy to where you got to get wiped out, start from scratch. Now you're out of the game. And of course, if you're out of the game, time is no longer working with you because you're not compounding. As we said, compounding does its best work over time. Warren Buffett had $1 billion to his name at the age of 60. 99, he's 90 now. So 99, he's been investing since he was 11. 99% of his wealth came after the age of 60. He's worth over $300 billion right now. Well, Berkshire has $300 billion. He's about around 100, 200 billion, a billion, and he's giving away a considerable amount. The thing is, the compounding machine, the engine that is compounding, took off after the last 30 years, which 99% of his wealth came in, is when the compounding engine really moved in his favor. He's been investing since he was 11 and hasn't stopped. So you got to think about all of the swings and all of the things that you're able to endure with that amount of time in the game. And no matter what, the U.S. economy, from what I've studied, the people that I told you that I look up to and take advice from in the investing field, the American economy, the American business, strong businesses always bounce back. The economy always bounce back. Strong businesses get better during downturns. They swallow up the people that aren't strong and aren't solvent. And of course, whenever people fail, some people swoop in and gather up their assets, like when certain banks collapsed, and of course, JP Chase came in, but basically bought all their assets on their balance sheet at a discount. And then, of course, we're able to exponentially grow their company as a whole and add to what they're doing. So this is the boring investor breakdown. This is what you can expect. Again, I'm your host, Stock Market Jay. I'm here to say today, bring you some news you can use. And until next time, peace.